Good evening. We begin tonight with a detailed examination of conditions in the silver market, where the spot price is currently sitting at $85.12 following a session that saw an intraday low of $83.10 earlier today. Curious, while the price recovery from that low has been noted by market participants, analysts tracking institutional positioning data, physical inventory figures, and global premium spreads are presenting a picture that they say warrants close attention beyond the surface-level price movement. At the center of tonight's analysis is the positioning data contained in the most recent Commitments of Traders report, dated March 10th. According to that report, commercial traders, the category that includes major financial institutions and bullion banks, are collectively net short 112 million ounces of silver. Managed money funds, which include hedge funds and algorithmic trading systems, are simultaneously holding net long positions of 52 million ounces. Analysts say the interaction between those two positioning groups is the primary dynamic shaping short-term price risk in the current environment. Drilling further into the institutional side of that data, analysts point specifically to JP Morgan, which is reported to be carrying a net short position of 45,200 silver futures contracts. Each contract represents 5,000 ounces of silver. That means JP Morgan's reported short position amounts to 226 million ounces of paper silver. For context, the COMEX registered silver inventory, the physical metal officially available for delivery to settle futures contracts, currently stands at 98.5 million ounces as of this morning's report. Analysts note that JP Morgan's reported short position alone therefore exceeds the entire deliverable physical inventory at the exchange by more than 2 to 1. Citigroup is reported to have added an additional 8,200 short contracts during the current week. Beyond the positioning data, analysts are also pointing to a set of physical market conditions, spanning domestic dealer inventory, global premium spreads, and structural supply-demand figures, that they say tell a materially different story from the current futures price. When we return, we will examine each of those components in detail, beginning with the specific mechanism analysts say is currently being employed to manage price levels and the physical inventory data that underpins their broader assessment. To fully understand tonight's silver market conditions, it is necessary to examine both the specific mechanics that analysts say are shaping short-term price behavior and the physical inventory data that they describe as the foundational backdrop against which those mechanics are operating. Beginning with the margin structure, analysts point to a decision by the CME to raise silver futures margin requirements by 5% approximately 5 days ago, bringing the initial margin requirement to $25,000 per contract. Analysts describe the timing and effect of that decision as significant. The margin increase was implemented on a Monday. Price began declining on Tuesday. By Wednesday, silver had reached an intraday low of $83.10. Today's session produced a recovery to $85.12. Analysts note that when margin requirements are raised, traders who cannot or choose not to deposit additional capital are compelled to reduce their positions, a dynamic that generates selling pressure independent of any change in fundamental market conditions. That margin requirement remains in effect as of tonight's session. On the positioning mechanics, analysts describe what they characterize as a structured approach to targeting the managed money long positions currently sitting at 52 million ounces. The technical levels they identify as relevant include a 150-day exponential moving average at $80.10, a major support level at $78.50, and what analysts describe as a substantial cluster of stop-loss orders concentrated between $82 and $83. Order flow data is reported to show a volume profile gap just below $82.50, where analysts say buying support is minimal. In that environment, analysts say a price push through $83 toward $82 would trigger automatic liquidation of managed money long positions in a cascade sequence, with the resulting selling pressure potentially driving the price lower still before buying support re-emerges. Analysts also note that the overnight session, when United States markets are closed and only Asian and European trading desks are active, represents the period of lowest liquidity in the silver futures market, and that every major silver price decline over the preceding decade has originated during overnight trading hours. They attribute that pattern to the reduced number of buyers available to absorb selling pressure during those hours, which allows price to move more rapidly with less capital deployed. Turning to the physical inventory picture, analysts present a set of figures they describe as structurally significant independent of any short-term price action. COMEX registered silver inventory stood at 116.7 million ounces at the start of the current month. As of this morning, that figure has declined to 98.5 million ounces, a reduction of 18.2 million ounces in approximately 30 days. Analysts calculate that daily drain rate at approximately 1.2 million ounces. Dividing the current inventory of 98.5 million ounces by that daily drain rate produces a timeline of approximately 82 days before registered inventory reaches zero, a date analysts place in the first week of June 2026. Against that declining inventory, delivery demand is reported as follows. 2,450 delivery notices have been filed so far in March, representing 38.6 million ounces demanded. 45 million ounces are currently standing for delivery. That figure represents approximately 46% of the total current registered inventory of 98.5 million ounces, meaning that nearly half of all deliverable silver at the COMEX is already committed to pending delivery obligations, with more than 2 weeks remaining in the month. Open interest across all silver futures contracts currently stands at 178,500 contracts, representing 894 million ounces of paper silver claims, against the registered physical inventory of 98.5 million ounces that produces a paper-to-physical ratio of 9.1 to 1, meaning there are 9.1 ounces of paper silver claims for every single physical ounce available for delivery. Analysts describe this as the highest leverage ratio in COMEX history. The divergence between the futures market price and the physical market price is further illustrated by current retail dealer conditions. The COMEX spot price is $85.12. However, analysts report that purchasing a single 1-ounce silver round from major United States dealers, including APMEX, JM Bullion, and SD Bullion, currently requires payment of $90 to $93 per ounce, representing a premium of 6.1 to 8.8% above spot. Furthermore, 87% of major dealer inventory is reported as back-ordered, with delivery times running approximately 12 weeks. The United States Mint has zero allocation of Silver Eagles. Royal Canadian Mint Maple Leafs are available on pre-order only with a 6 to 8 week delay. Royal Mint Britannias carry a 4-week backorder. The Perth Mint is rationing purchases with a 6.2% premium and reports limited stock availability. Having examined the domestic physical market conditions, we turn now to the international premium landscape, a set of data points that analysts say provides additional context for understanding the relationship between the current COMEX futures price and the price at which physical silver is actually changing hands across major global markets. The Shanghai Futures Exchange is currently pricing silver at $86.20, a premium of $1.22 above the COMEX price, representing an arbitrage gap of approximately 1.4%. Analysts note that in a normally functioning efficient market, such a persistent gap between two major exchange prices for the same commodity would not exist, and they attribute its presence to a directional flow of physical silver from Western markets to Eastern markets that is not being reversed. China's silver export data supports that characterization, with China reported to have reduced its silver exports by 62% on a year-to-date basis. Shanghai Futures Exchange warehouse inventories have declined 75% on a year-over-year basis, sitting at approximately 350 tons. Additionally, 3 trading firms were reported to have been suspended from the Shanghai Exchange last week for what authorities described as irregular activity. In India, physical silver is reported to be trading at a premium of 5.3% above spot price, translating to approximately $89.48 per ounce at the physical window. Analysts attribute the elevated Indian premium to a combination of factors including the approaching Akshaya Tritiya festival, described as the single largest gold and silver buying day on the Indian calendar, and the structural weight of India's existing precious metals holding base, estimated at 40,000 tons of gold, with proportional silver holdings across Indian households. Analysts characterize the 5.3% premium as an indicator that local Indian demand is currently overwhelming the available supply chain, with metal that would otherwise flow to Western dealers being redirected to Indian wholesalers willing to pay higher prices. Additional international premium data shows Dubai at 3.3% above spot, Japan at 2.2%, the United Kingdom at 4.8% with Britannias on multi-week backorder, and Canada at 4.7% with Maple Leafs reported as completely sold out through April. Analysts summarize this global premium structure as one in which every major silver market on the planet is paying a meaningful premium above the COMEX spot price, with the COMEX futures price representing the sole venue where silver appears to trade without a significant physical scarcity premium. Turning to the structural supply and demand picture, analysts present the following figures. Global annual silver supply from combined mining and recycling sources is approximately 1.02 billion ounces. Global annual demand across industrial, investment, jewelry, and silverware categories is approximately 1.28 billion ounces. The resulting structural deficit is 260 million ounces per year, representing a 25% annual shortfall between supply and demand. Analysts note that this deficit is in its sixth consecutive year, and that the deficit is reported to be widening rather than narrowing. On the demand side, solar panel manufacturing is identified as consuming 200 million ounces of silver per year, up 22% on a year-over-year basis. Analysts note that silver paste is used in the electrical contacts of every solar panel in production and that no commercially viable substitute exists at scale. Electric vehicle production is consuming 85 million ounces annually, up 18% year-over-year. Artificial intelligence data centers, including large-scale server facilities operated by Microsoft, Google, Amazon, and Meta, are consuming 12 million ounces annually, with that consumption growing at 35% per year. Analysts identify silver's superior electrical conductivity as the basis for its use in servers, connectors, and high-performance computing components. On the supply side, Fresnillo, identified as the largest primary silver producer globally, has reduced its 2026 production guidance to a range of 42 to 46.5 million ounces, down from a prior guidance range of 45 to 51 million ounces. The Peñasquito mine in Mexico, described as one of the world's largest silver-producing operations, is reported to be experiencing ongoing labor action that has removed an estimated 10 million ounces from annual supply. Regarding the calendar of upcoming events, analysts identify several developments they say are likely to affect the silver market within the next 5 days. The Federal Reserve's Federal Open Market Committee is scheduled to meet on March 18th and 19th, the following Tuesday and Wednesday. Markets are currently pricing a 65% probability of a 25 basis point rate cut at that meeting. The most recent consumer price index reading came in at 3.2% year-over-year, and the producer price index at 2.8%. Jerome Powell's term as Federal Reserve Chair is reported to expire in May 2026. President Trump has nominated Kevin Warsh as Powell's replacement. Warsh is described as favoring tighter monetary policy and potential balance sheet reduction. His confirmation hearings are expected to affect markets prior to any actual policy decision, with his first potential rate decision identified as the June 17 FOMC meeting. Analysts also reference the geopolitical situation involving Operation Epic Fury, launched on February 28, when United States and Israeli forces struck over 2,000 Iranian targets, including the Natanz nuclear facility. Supreme Leader Khamenei was reported killed on the first day of the operation. Silver spiked to $96.40 briefly before declining 7% within the same trading session. The Strait of Hormuz is described as effectively closed, not through physical blockade, but because insurance companies have withdrawn coverage for commercial shipping through the strait. Maersk and Hapag-Lloyd have suspended Middle East routes. Brent crude surged from $70 to over $110 per barrel. The International Energy Agency released 400 million barrels from strategic reserves in response. Analysts note that a potential United States-Iran agreement, within what is described as Trump's stated 4-week window, could reduce the geopolitical premium currently embedded in the silver price, while noting that the underlying structural supply deficit would remain unaffected by any such development. On the technical side, the 14-day relative strength index is currently reading at 42, a level analysts characterize as oversold territory. A bullish MACD crossover is described as imminent based on current momentum readings. The price is sitting at the lower Bollinger Band, with trading volume reported at 145% above the 20-day average. Analysts identify an inverse head and shoulders pattern forming on the chart, with a neckline at $88.50 and a measured move target of $105 if that neckline is breached with conviction. The 200-day moving average is currently at $65.20, a level 30.3% below the current price, which analysts describe as confirmation that the long-term bull trend remains intact. The 50-day moving average at $88.50 is identified as the key reclaim level, above which analysts say the next technical targets become $92, $96.50, and ultimately a retest of the all-time high at $121.88. Regarding the gold-silver ratio, analysts note that the current reading stands at 60 to 1. The 30-year historical average for that ratio is 67 to 1. During the 2011 precious metals bull market, the ratio reached 32 to 1. Analysts note that at a ratio of 32 to 1, with gold priced at $5,098, silver would be valued at approximately $159 per ounce. Analysts also observe that the ratio has historically reached a cyclical bottom approximately every 5 years, with prior bottoms identified in 2011, 2016, 2021, and the current year 2026 identified as the next point in that cycle. The range of institutional price forecasts for silver reflects what analysts describe as a significant divergence of views among major financial institutions. JP Morgan's current forecast places silver in a range of $81 to $85 by the fourth quarter of the year. Wisdom Tree projects a year-end price of $80. Scottsdale Bullion projects a price of $160 in a scenario where the gold-silver ratio compresses to a range of 40 to 50. Bank of America's original model pointed to a range of $234 to $309 by year-end. Analysts present this range, spanning from $80 to over $300, as illustrative of the degree of uncertainty currently present in institutional assessments of the silver market. To summarize the complete set of key facts presented in tonight's coverage, silver is currently priced at $85.12 on the COMEX, following an intraday low of $83.10 earlier in today's session. JP Morgan holds a reported net short position of 45,200 futures contracts, equivalent to 226 million ounces, more than twice the current COMEX registered inventory of 98.5 million ounces. Citigroup added 8,200 short contracts this week. The most recent COT report shows commercial traders collectively net short 112 million ounces, while managed money funds hold 52 million ounces in net long positions. The CME raised margin requirements by 5% 5 days ago, bringing the initial margin to $25,000 per contract. COMEX registered inventory has declined from 116.7 million ounces at the start of the month to 98.5 million ounces today, a loss of 18.2 million ounces in 30 days, at a daily drain rate of approximately 1.2 million ounces. At that rate, analysts calculate registered inventory reaches zero in approximately 82 days. 45 million ounces are currently standing for delivery, representing approximately 46% of total registered inventory. The paper-to-physical ratio stands at 9.1 to 1, described as the highest in COMEX history. Physical dealer premiums in the United States are running 6.1 to 8.8% above spot, with 87% of major dealer inventory on backorder and delivery times of approximately 12 weeks. The United States Mint has zero Silver Eagle allocation. The global annual silver supply-demand deficit stands at 260 million ounces, the sixth consecutive year of deficit. Solar demand is up 22% year-over-year at 200 million ounces annually. Electric vehicle demand is up 18% at 85 million ounces. AI data center demand is growing at 35% annually. Fresnillo has cut 2026 production guidance. The Peñasquito mine labor action has removed an estimated 10 million ounces from annual supply. China has cut silver exports by 62% year-to-date. Shanghai Futures Exchange warehouse inventories are down 75% year-over-year. International physical premiums range from 2.2% in Japan to 5.3% in India. The Federal Reserve meets March 18th and 19th with a 65% market-implied probability of a rate cut. Jerome Powell's term expires in May 2026, with Kevin Warsh nominated as his replacement. Operation Epic Fury launched February 28th, with silver spiking to $96.40 before retreating, and the Strait of Hormuz effectively closed to commercial shipping. Brent crude has surged from $70 to over $110 per barrel, with the IEA releasing 400 million barrels from strategic reserves. These are the conditions defining the silver market as of this evening. We will continue to monitor COMEX inventory data, physical premium spreads, delivery notice filings, and developments related to the Federal Reserve meeting and the geopolitical situation as they evolve. For all of us here, thank you for watching, stay informed, and good night.